Hello and welcome to this very special interview on the Money Paathshaala. Joining me today is a very young person, but with his permission, I'd like to call him a veteran because he has more than, I think, almost close to 25 years of working experience in the private sector mutual fund industry. Currently, the executive director and CEO at Whiteoak Mutual Fund, but has worked across mutual funds and is a great equity guy. Played multiple roles across his career. Thanks very much, Aashish. It's always a pleasure talking to you. My first question to you is around SIPs. Your team has put together some very interesting research around SIP, and they have studied very long periods of time, and this has gained a lot of acceptance among even advisors I see on social media. So could you tell our viewers a little about what this study reveals about how to invest in an SIP or when to invest in an SIP?
Sure. Thank you very much for inviting me, and also, of course, very topical, very pertinent. What you just alluded to is, in fact, kind of making some news items in the leading, business dailies, because that by far the most preferred mode of investing into equity mutual funds for retail investors, has been by way of registering systematic investment plans, especially in these equity funds. But the juncture at which we are, and where we did this whole study, the juncture at which we are, last 18 months, the Nifty and the Sensex, the market by and large last 18 months has gone nowhere. And typically people are highly engaged with stock markets and with their investments if the market is either booming or if the market is correcting heavily. But times like these, when for a long stretch market goes nowhere, and when I say market has gone nowhere, what I mean is that in October 2021, Nifty crossed 18,000. And November 2022, again Nifty made like a new high of 18,900. And even now we are at say 17,000 kind of levels, and we have consistently been between 17, 18,000 Nifty. As a result of which people haven't made, whether it's lump sum or SIP, last year and a half, couple of years, people haven't made much return. So the study we performed actually was to highlight to people, and it was actually encouraged by this newspaper article which said that a lot of people have reduced their commitment to SIPs, and some people have even started, they've kind of stopped adding to their SIPs. And that's where we created this whole analysis which said that for an SIP, come to think of it, a slow start is a good start. And what does that mean? What we did was that generally, by and large, most SIPs in the industry are 5 years, 10 years kind of, they run for 10 years. So what we did a study, it basically showed that in the past, let's say last 20, 30 years, you go back in history and you see that at any point in time, if you registered an SIP for 10 years, how did it actually perform? And our data, not so surprising, but still counterintuitive, our data showed that whenever an SIP has had a slow start, it's a great start. What do I mean is that the analysis showed that if you had done multiple times, over a number of years, if you had done discrete SIPs over 10 year time frames, it would show you that whenever after commencing an SIP, if the return in the first 5 years is say worse than a deposit, let's say you started an SIP, it's been going on now for 5 years, and the return is less than 8%. So obviously by that time people get highly, they get demotivated and they are not encouraged to continue. But the data actually shows that whenever an SIP has been started and in the first 5 years, let us say the return is less than 8%, then at the end of 10 years, it turns out to be some 17, 18% compounded return. On the other hand, whenever an SIP has been started and in the first 5 years, let's say it does well, it gives you more than 8% in the first 5 years itself. At the end of 10 years, it ends up 14, 15%. So what it actually tells you is that, if you are a long-term investor, if you're doing an SIP for say 10 years, the point is that in the first 5 years, if the market does nothing, if you get poor returns in the first 5 years, you will be disenchanted. But what it would actually mean is that when the market is doing not much at lower and lower levels, a lot of your money has got deployed, and then
Mm.
market goes up on a back-ended basis, you get huge appreciation on large number of units, you get huge appreciation. On the other hand, the moment you start, if the market starts booming, that means the market started to go up. So you get less number of units, and then later on the appreciation comes on less number of units. So
Mm.
I think slow start is a good start, and people who haven't made much return in SIP in the last, couple of years, they are actually the probability of them making a very good return in future. The probability actually goes up.
Unfortunately, Ashish, people tend to not have the patience. And the
Yeah,
minute, as you rightly said, there is a period of a year and a half where it's pretty much been flat or even marginally negative, they start getting worried. Are you seeing from whatever in your own fund, or you speak to your peers, the fact that people are stopping SIPs at this point? I know that's not the right thing to do. Of course, if there is some stress, we keep reading about a lot of layoffs,
hmm.
especially across tech companies, and these were the early movers. You would agree, the employees there who understood the importance, and they were more aware, and they started
Yeah.
investing. Uh, is it because of that, or is it because of the fact that people, despite all the best efforts to educate them, still lack the ability to be patient enough?
So let's look at it in two parts. I mean, I definitely one must expect, or one can understand that if salaried employees or salaried individuals in certain sectors in some parts are witnessing, poor employment prospects, or a slowdown, or in some cases, let us say some early signs of. I mean, we hear a lot about US, but in India, it's layoffs and those things. Our economy seems to be doing much better. But let's assume even if inflation, higher interest rates, more outgoing EMIs, let's say those could be some of the challenges. So I came across this data actually, which shows that the banking system is doing just fine. I mean, as far as banking system is concerned, because banks lend a lot, right? So I'll come to the SIP bit, but because banks are involved in mortgage loans and consumer loans and stuff, banks are not seeing any delinquencies. In fact, the collection efficiency is at the highest point right now, and banks are not witnessing any stress. Now, I can imagine that if at all there was any stress, people might give up on their SIPs or slow down their investment, but definitely they will not give up on an asset which they've acquired, whether it's white goods or a automobile or mortgages. But to begin with, I think that there would be some correlation, right? If we feel that people are not able to honor their SIPs, then on the margin, it should also show up in their ability to repay, their mortgages and white goods and automobiles. So I think as of right now, if you follow banks, NBFCs, etc., they are not reporting any stress at all. Correct. Now come to SIPs. Yes, it is true that if you see the number of people who were registering new SIPs, that has slowed down, and people who already have SIPs going, yes, it has happened that the collections may be lesser while people registered an SIP, but they may not actually be honoring that SIP or allowing the installment to get debited, or they may be missing some installments, or some might be even stopping. So that there is a bit of a rise in trend. So I think where people have borrowed, I know that the borrowing has to be honored, whereas SIP is an investment. So I'm not trying to equate the two. But point is that if you see industry data, where people have borrowed, you can see that there is no stress. On the other hand, where people are making investments, there is some amount of slowdown. So I would say that the latter is more related to being demotivated because of recent return. And I have seen this that it's an education issue, like you rightly pointed out. Whenever the recent return is not good, people are actually demotivated about committing more. Whereas, like you quoted our study, and like I gave that long explanation, the reality is that if you haven't, when you're doing an SIP, if you didn't make return in the last couple of years, it's good, because the probability of you making a outsized return in future actually goes up. So
Mm.
yes, it's more an education issue, and more challenged due to recent market movements.
On the mortgage bit, I just have one quick point, Ashish, because I know it doesn't pertain to mutual funds, but then you go beyond mutual funds as a professional. Um, One is also seeing, and I think that could be the reason why there is less stress. We are also seeing, tenures being increased. So,
Yeah, yeah, yeah.
somebody who's in their mid 40s, like you, is being actually told, okay, don't increase your EMI, but you keep paying me till you're 70,
Yeah, that could be.
75, 80 years old. So maybe therefore there is no stress. But when I am in such a situation, the
Yeah,
first thing I'm going to do is to get a little uncomfortable about committing further money and try and
further
probably
money. Yes,
prepay.
yes,
That could be the reason. It's just my,
could be. Yes, yes,
thought.
yes,
I know we
yes,
don't
yes.
have any evidence to suggest that, but that could be the case. But let me move to the other big development, and you've talked about it. I was seeing in one of your interviews, you said this will change the mutual fund industry forever. It'll never be the same. Is the whole debt fund taxation
Hmm.
thing, which came, what should one say? All adjectives have been used already. So, but the fact, do you feel? Let's move forward. Now, this is a reality. We can criticize it, but the fact is now this is the law of the land. And I know
Of
that
course.
people like you and others may be trying very hard in the next, whatever, we are recording this interview on the 29th. So there's 2 more days. And I'm sure you're trying your best to lock in people. But post that, let's try and understand. There is no doubt that debt is a very, very important part of asset allocation, something you've been saying for many, many years. Do you therefore see? So I don't think any financial planner will say that, look, I don't want you to be in debt just because it
Yeah,
has taxation. But pure debt schemes, and we don't need to argue about how good they were. I mean, the
yeah.
target maturity funds, the ETFs, they were all serving a good purpose and were about to take off. But well, let's leave why it happened to a separate conversation. But do you foresee categories like hybrid, like balanced advantage fund, about which we've talked in our previous interviews, equity saving schemes, schemes of this kind becoming more popular? They're already fairly popular
Yeah.
because from a advisor or a distributor's point of view, you would obviously want an investor to have a good asset mix. And rather than creating portfolios of debt schemes, you might just go for a more of a, balanced advantage fund, or a, I don't know. There are many categories, and if you can talk about that.
So yes, I think that clearly for fixed income funds, before this latest change, the fact that anything held for 3 years was, classified as long-term capital gains, and that entailed 20% tax less indexation, which would, in a certain environment, tantamount to pretty much very low tax or no tax. So now that is clearly gone, right? And everything would be classified as short-term gains. There is no such thing as long-term gains for debt mutual funds. So that has, really taken away one big advantage, because in the past, interest income was getting classified as capital gain, and hence, uh, so I think there were some advantages. Now, clearly, having gone, what it does is that the people who want to invest purely into debt, before I come to your point about how will people manage the mutual funds and the allocation. Let us say somebody was going to invest purely in debt, and putting money in equity of any sort is, let's say, not an option. So people who are going to go only into debt, now they will not just straight away go into a mutual fund. They'll compare that, which instrument has the highest headline return and entails the least expense. And, that's what they'll go for, because tax treatment would be same everywhere. In fact, a lot of people like corporate treasuries and family offices or certain HNIs, they might even just directly hold some bonds which are listed, and they might still be able to enjoy capital gains on those bonds. So people who are pure fixed income will go for the highest possible headline rate of return, because mutual funds don't have any tax advantage now. Coming to retail investors, look at it this way, that previously when people were buying debt funds, like you mentioned, target maturity or any of those, holding for more than 3 years was classified as long-term capital, long-term gain. which means that to get a concessional rate of tax, you had to anyway hold for minimum 3 years. Now, if you're not a corporate or if you're not somebody whose constitution precludes you from putting money in equity, and let's say you're allowed to put in equity or you don't mind putting money in equity, so you will think that, okay, anyway, I was going to hold for more than 3 years. What's the harm if the fund has, 15, 20, 30% into equity? Because yes, 3 years, 100% equity, you're definitely taking some risk. But if you're going to hold more than 3 years and the fund has, let's say, 35% in equity and 10, 15% worth of arbitrage, which reduces the effective equity position to say 20% or something, then I think it will still have long-term capital gains after 3 years. It will still be 20% less indexation. And some of your equity allocation, you can carry it through this hybrid kind of fund. Same logic, I think, applies, when you mentioned balanced advantage funds. Now, ideally, people put money in equity, they put money in debt. But if you put money in a balanced advantage fund or an aggressive hybrid fund, which ends up putting 30, 40, 50% of your money into fixed income, but is still taxed as equity, then you will say that, okay, it's better to create debt and equity as hybrid exposure, and the whole, whatever small part or whatever part of debt you have, that also enjoys the lower rate of taxation. So clearly, I think, I mean, I'm not in the camp that taxation should determine your asset allocation. But the point is that if your ultimate asset allocation is going to be what it is, and it can be more efficiently met through hybrid funds, then I think people will definitely be open to choosing that.
It's also about simplicity, isn't it, Ashish? I mean, fixed deposit is something a lot more people in India understand than even a mutual fund. Forget about debt or equity. And if the difference is very marginal, I mean, I know as a mutual fund company head, you have to, probably, I'm not talking about you individually, but as the industry. But the fact is that if it is a very small difference, I'd rather go to a product that I understand, which is a fixed deposit.
Yeah, no doubt about it.
And probably, and I know in your previous avatar, in your previous role, you never had debt funds. You were a pure play equity mutual fund CEO. And I know that, today the industry was trying to bring in retail investors to benefit. And maybe now the real fun would be in educating people and making them understand balanced funds and equity more as an asset class. Perhaps, let's see how it evolves. But thank you very much, Ashish, like always, for taking time out and speaking to me. I look forward to many more conversations with you here on Money Paathshaala. Thank you very much.
Thank you. Thank you for inviting me. Thank you very much.